talking to me, you're going to get updates from me, whether you're on the listing side, the buyer side. The communication piece is critical there. Getting clients to closing quickly is something that we take a lot of great pride in, especially during the last couple of years where it's been really busy. Keeping those under 30-day turn times, even during the busiest times the last couple of years, is something that we take great pride in. And the way that we can do that is because the furthest that loan's ever going to go is Louisville. You know, we've got underwriters here in Lexington. We have like an open door policy when it comes to communicating between those. I talked to other folks and other mortgage companies and other lenders, and they can't talk to their underwriters. Hi. But it's not that way at Republic. We really collaborate together. We work together to get the deal done. So we're all working towards that same goal. Another thing that kind of sets us apart is our in-house loans. So we'll talk a lot about those today, but on the right-hand side, you'll see we do all of your standard FHA, VA, USDA, your government loans, your conventional loans. We offer those. We are a Kentucky Housing delegate, which means that we can get those deals done really quickly too. So we do a lot of Kentucky Housing deals, utilizing their down payment assistance option when one of our in-house options isn't the best fit. So today we're going to talk about more on the left-hand side here, some of our things that we do in-house. The first one that we're going to really talk about is the Professionals Loan Program. This is one that we rolled out last year, and it really caters towards clients that have professions such as a lawyer, a CPA, nurse practitioners, PhDs, pharmacists. So those are going to be professionals that would fit into this loan program. And you can kind of see some of the things that are going to be across the board with our in-house programs is that you're not going to have any PMI attached. So that can make a huge difference. All of our in-house loan programs, aside from our neighborhood housing, are going to be an adjustable rate mortgage. Those have become a lot more popular, even for clients who fit perfectly in that conventional box, just because rates have been so volatile. Don't know, like a couple weeks ago, closer to Groundhog's Day, we were under 6, right around 6. This morning they hit 7, so there's a lot of volatility there, and as you all know, that can make a big difference in affordability, what your clients can purchase, their payments. So we're doing a lot more educating on ARMs, and we'll kind of talk to you all about that so that you can translate that onto your clients who might be looking at other loan options aside from just that traditional 30-year fix. But the Professionals Loan Program, they can put as little as 5% down. You can see that we go up to $1 million on this, so you're not going to have those jumbo underwriting guidelines to deal with. We've got some of the other criteria there, but this is a great program, and those rates are still in the 5s. So that's something to keep in mind too. When I checked the 30-year mortgage rate this morning, it was 7, and we've still got rates in the 5s for a lot of these programs. Our construction to perm loans. So this is going to be, we've got a lot of clients kind of getting into that new construction just because of inventory, limited inventory around this area. I have a lot more clients interested in doing new construction. We make the construction loan process really easy. We vet the builder, and then we have somebody that's designated. It is an assigned person in our construction loan team that will work with the builder for their draws and will work with the client throughout that process. The loans on an interest-only payment, we can turn those in under 30 days, and they can do a one-time close, so they can go ahead and fix in. So most of the time for construction loans, a client is floating their permanent financing rate during the construction phase, which is usually about a year. And then they're going to be subject to whatever market rates are after construction. We can lock their permanent financing in on the front end as well. So one of those things that kind of stands them apart, so they don't have to worry about what rates are going to look like in a year. The next is our physicians, dentists, and veterinary loans. So similar to our professional loans program, we have standalone ARMs that anybody could fit into, as far as as long as they're putting 10% down, anybody could do an ARM, or one of our in-house adjustable rate mortgages that has that no PMI lower rate option. But when you're talking about these specialized professions, like what we talked about with the Professionals Loan Program, or a physician, dentist, or a veterinarian, we offer even more premium pricing for those folks and zero down, so we can do 100% financing. Same thing for medical resident students or dental resident students. And then our neighborhood housing is a really popular option. So this is our low to moderate income option. And just so that you all know, the kind of the difference between us as a bank and like a standalone mortgage broker is a bank is required to have so many Community Reinvestment Act loans. We're required to by FDIC. So as a way for us to help us meet that goal, we have developed this loan program that really just focuses on low to moderate income borrowers. And a low to moderate income borrower for Fayette County would be considered anybody who makes less than $69,840 a year gross income. So that kind of can take in a lot of times we offer this program for teachers, nurses, some of those types of professionals. And this is a great option because this rate is still under 5%, fixed for 30 years, no PMI, and we can go up to 100% financing. So when you are thinking about the difference in that 7% rate that we were talking about on the 30-year fix, plus adding in PMI, if they're not putting 20% down, which a lot of them aren't, you're talking about, it's, we can put it in payments, like we'll compare payments and show them what that difference would look like. But for you all, that means increasing that buying power by, sometimes that same payment increases that buying power by $30,000 to $50,000 just in the difference on that payment between 5 and 7%. So that can, as you all know, with inventory and the way house prices are, being able to get someone in at $250 as opposed to $200 or $300 as opposed to $250 opens up a lot more opportunities for them to purchase based on that rate and no PMI.
What's the lowest credit score for that program?
640. And their rate is not going to be different if their credit score is a 640 or a 740. They're still going to have that under 5% rate. Now, one caveat is it's only available for properties in Fayette or Scott counties because that's where we do get that Community Reinvestment Act credit. So I do get questions sometimes about surrounding counties, but it would have to be for properties in Fayette or Scott.
And this is just applicant income, so it's not household income. So if you had a married couple and they made too much together but won't qualify on their own, we can look at it that way. We always dissect it and try to look at that. If we can fit somebody into this program versus KHC or FHA, that's what we're going to do every time, just because, like she said, it makes such a huge difference in the monthly payment. So.
Is this the loan you did for my client last one? That's what I thought.
Yeah.
It's a very, very popular one.
Yeah. So, yeah, in case in point, like with that, I mean, there's clients that have gone to other banks and like they're like approved for $150,000, and then we can get them into this, and it literally does take them up to about $190,000, $200,000. I know that's still hard to find, but I mean, it's more doable than anything under $200,000, right?
That's when there's more options.
Yeah.
For sure.
Absolutely. So, and the house can also qualify too.
Yes.
So, if the applicant makes too much money, we can put the property address in a geocode map, and if it's in a low to moderate income area, that can make it qualify as well. So I've got a client right now that makes $95,000 a year, but he's doing this program because his house in Lexington is in a low to moderate income area.
What's the income limit?
69,000.
69,000.
And does it, fall in Lexington as well, or
Yeah.
just Scott County? That's
If, yes, Fayette or Scott.
How hard is it for self-employers to apply for that one?
Just look at their tax returns.
Yeah.
Same thing.
Okay.
And on our portfolio, a lot of times, we only look at 1 year of tax returns and not 2.
And sometimes not even the business, just the We've spoken
Yes.
Rebecca's
Yes.
absence, yes.
They are on top of the game and so good. I mean, I'm so
Thank
grateful.
you.
It was not easy to close on that property, but
We got it done.
so patient and so nice. Yeah.
Thank you.
Yeah, thank you.
And you want to take it over from here, yeah.
So just to kind of piggyback on what Dawn's been talking about, so, when rates started really going up last fall, and you had, lenders coming out saying, hey, let's do 2-1 buy downs, that's what we'll do. Those are great, I mean, they really are, but seller, builder, or the bank or lender has to pay for that buy down. Okay, so when we get back into the spring market and we still have this inventory shortage going on, sellers are going to be paying closing costs. Builders might still, but that's the catch, the 2-1 buy down. And a 2-1 buy down is also going to cost depending on the loan size, it's gonna cost several $1,000s to buy that rate down, and it's only buying it down for 2 years. So the first year it's gonna buy it down 2 points, second year it's gonna buy it down 1 point, and then it's gonna go up to whatever the current rate was at the time. So like today, that could be 6.875%. So if clients are leaning towards doing that option, our portfolio ARMs that are fixed for 5 years or fixed for 7 years stay in that 5% price point for the whole 5 years, the whole 7 years. And then if you have a seller or a builder that wants to pay closing costs, they can pay their actual closing costs and not pay to buy the rate down short term. So that's where we came up with this date the rate, marry the home kind of thing, So, marry the house, date the rate. When rates dip back down, refinance. And ARM doesn't have a prepayment penalty. No mortgages have a prepayment penalty anymore. So, when you have clients like, ooh, I've heard ARMs are bad, ARMs caused the housing market crisis of '08. There is a little truth to that, but those ARMs were only 1-year ARMs and 2-year ARMs, and they had prepayment penalties that were longer than the fixed rate. They were 100% financing for people that had 620 credit scores. So, they were really risky loans that are gone off the table. Republics had these ARMs, gosh, I don't know, 15, 20 years. We didn't have foreclosures in the housing market crisis, because the criteria on this is still, you're gonna put some money down, you're not gonna have PMI. But this slide, and it's probably a little hard to see, but it just kind of gives you an idea of what, like, we did 30-year mortgage at 6.5 versus our 5 or 7 year.
Kind of see the
You can
pencil
see
in it.
those monthly payment differences right there. So, not only is the rate a whole percent or more lower, but there's no PMI. So again, it's just giving your client more buying power. You might have somebody that's like, I want to buy more than 280, but I can't. Well, if they call us with their rate being lower and not having PMI, it's highly possible. Or that self-employed buyer that they've looked at 2 years tax returns, we might just look at the last year. So many self-employed people were, impacted badly by COVID. So, being able to look at a 2022 tax return or a 2021 tax return is a lot better than averaging out 2020 with that, so.
And we try to educate too that the average life of a mortgage is 5 to 7 years. Most of us in this room have never paid off our 30-year mortgage because we've either moved, we've sold, we've needed to pull that equity out, or there's been a rate opportunity to refinance before then.
And I guess, I should have gone to this slide because everything I just said right there. So this is a new PowerPoint that just rolled out this year, and obviously I did not look at it. So, so yeah, but just kind of go into telling you like how an ARM will work. So again, it is locked in for 5 or 7 years. We do have one of our physician programs is a 10-year ARM as well. So, that rate is locked in about 60 to 90 days out from that first adjustment period. So, for example, if they did a 5-year loan around their 57th, 58th month, we're going to send them a letter reminding them that they did an ARM, giving them an idea of what's going to happen with their rate and payment. And so they have a lot of opportunity to refinance at that point. So, and they have paid down more on their principal because their rates are in the 5s versus almost 7%. So when they refi, their loan to value should be a lot less too. So, anything else to add?
Other than just that it can only change every 6 months, so not every month the rate's gonna change, and then there's those caps that, so they're not gonna go, it's not gonna be like, it's not gonna start at 5 and then go to 9 or anything crazy.
You want to talk about that?
Sure, our home equity line of credit, one of the things that I didn't talk about was the bridge loan program, and I don't know if we've got a slide specifically for contingency relief.
There it is.
Oh, okay, perfect. So we'll kind of talk about the home equities and the contingency relief hand in hand. Home equities have become a lot more popular for folks that decide to stay in their home, primarily because of inventory and because people have so much more equity than they ever did with values going up, over the last few years like they have. So people looking to tap into that equity, you can use it for anything. So a lot of people are remodeling to stay in their homes, but you can utilize that or a contingency relief loan, which is the next one, to help get you into the home that you want to buy. And we would talk to your client to figure out which one is the best fit because there are pros and cons to each. But essentially, our contingency relief loan, I wasn't sure how, I was telling Chris this, I wasn't sure how popular it would be this year. We've had this for a really long time, and before it was just more of a convenience tool where someone just, especially if you've been in your family home for 30 years and then you're going to move into a new home, you don't want the stress of having everything you belong in your in your packing truck, and you're trying to do your buy and your sell at the same time, and then you all are trying to list a house that's got 30 years worth of clutter in it. Like, it's more of like letting them buy their house and move into it and then sell their old house, right? So that was how it was kind of designed. But then when the market took such a shift and got incredibly competitive, contingent offers just weren't looked at. I mean, they just went to the bottom of the list. So it really came into play to help give you that next leg up on your offer, to be able to put a non-contingent offer in with someone who has a home to sell. People were in that, like, between a rock and a hard place where they didn't want to list their home to be sold because they knew it would sell so quickly, but they didn't want to be homeless. But they couldn't put an offer in on the house they wanted to buy with a contingent offer, so they were kind of stuck. And this has really been helpful to let them pull that equity out. We put it on an interest-only payment, pay off any existing mortgages that they have. Some people have mortgages, some people own their house free and clear. If they own their house free and clear, even if they don't and they're downsizing, they can become a cash buyer as well. So I just recently did that. I closed one last month for a family who had a house in Heartland Estates, and they 3-story family house they've been in forever. They wanted to buy that 1-level ranch. They were able to be cash buyers and pull that equity out. So it gave them obviously their offer was a prime offer, being a cash offer, and they did that by pulling the equity out of their current home. They listed their current home right away. It went under contract to be sold 2 weeks after they closed on the house they were buying. So they were able to take those 2 weeks, move in, paint, move in, move out of their old house, close on it, and they won't even make the first payment on the contingency relief because they're selling their current house so quickly after closing it. So it's just been a tool that's been super helpful to kind of bridge that, but it's, as opposed to the old school bridge loans that took both properties and you had to refinance later, they were really kind of complicated. It just makes it a lot easier, and has been super helpful. So keep that in mind if you've got a client that has a home to sell and they don't want to put a contingent offer in. It's been huge the last couple of years. And that's it. So I'll just wrap up by saying, we're a local lender. You all, if you've been in real estate long, you probably have a preferred lender. Let us be your backup. Let us take those deals that go sideways that somebody, can't. Or if you've got a client that's like, wow, I was pre-approved at 6%, now it's 7%, and I can't afford that. Any kind of situation like that, we'd love to take a look at it for you. And then my last thing is always to shop local. Even if it's not me, there's other great lenders in Lexington. I have friends at other companies that are just really great lenders. You're going to have a much better experience. Your client's going to have a much better experience. So if they bring you a pre-approval letter from an online lender, just go ahead and tear it up and say, call anybody local, because they've got to see you at Fresh Market or on the ball field. They'll be at your closing table. So it's just going to be a much less stressful. You're not going to pay any more for that service, and you're just going to have a much better experience throughout the buying process. So.
And they are amazing. I work with them, they are amazing. And they'll email, phone calls, anything and everything. They have solutions to everything, and they'll stand behind with you and your client.
There was a jumbo loan that we did last year that involved relocation, the Tuskegee one.
Yeah.
And oh my gosh, they would not respond at all, relocation company,
Yeah.
but we still close on time. It
Yeah.
helps to have someone sit on your team.
Yeah, we showed up at the closing, not even sure if the reload company was gonna have anybody there to close it. Like, it was definitely a one-sided deal that Kush was working hard on, but yeah, we've had the pleasure of working together a couple of times, and sometimes those jumbo loans, if we're able to take it in-house, just the underwriting, that process for your clients is gonna be so much easier.
Yeah, most of our in-house programs outside of neighborhood housing, if the client's putting 10-20% down, they just put their bank information on the loan application. Most of the time we don't get their bank statements. Bank statements can cause a lot of hurdles in a transaction, especially if you got a client that moves a lot of money around and does wonky stuff. So, bank statements we try to avoid if we can on these programs. Again, maybe 1 year of tax returns instead of 2. So, and I think Don mentioned this, but, we don't sell any of our mortgages either except for government. So Kentucky Housing obviously goes to Kentucky Housing, that's the lender, and FHA, VA, USDA, those get sold off. But all of these programs we talked about today are 30-year fixed with Fannie and Freddie. We service those until they're paid off. So the client really can, and every year, October tax time, I mean, we're fielding all those calls, what do I do with this tax bill, what do I do with this tax bill, and we're sending in the escrow department for them, you know, and stuff, so you get a little more attention even after the transaction's over, you know, I mean, because we're about building relationships and keeping them where we're here, so.
Yeah, we had a client who wanted his PMI removed because he had done some updates to his house and, you know, values had gone up, and so I was able to help with all of that kind of stuff too. So it's just all those service things after the fact, so it's a relationship rather than in, you know, before their first month's payment is due, it's gonna be sold off a few times.
And something else that we do, sorry,
No.
real quick, but the contingency relief loan, we go up to 90% on that. And we do that so that there's room to pay 6% real estate commission, transfer tax, you know, little wiggle room for the client. So they're gonna walk away with a proceeds check when you do finally sell their home. If we've done the purchase for them, they can take the proceeds from the sale of that house and put it down on the new purchase loan, and we'll recast the payment and adjust it down. So if you have a client that's like, well, that's great that they have a contingency relief loan, but I want every penny from the sale of my home to go on this purchase, that's what I need. We can do that too, where we don't sell the mortgage, we'll recast it, adjust the payment down for them, and problem solve with that too, so.
Regarding your physician's loan, does that also include other healthcare professionals like nurses, PAs?
The professional loan does,
Professionals.
the
okay.
5% down, but the physician loan is true MDs,
MD.
veterinarians, and dentists.
CDS, yeah.
And there's no PMI on the professionals?
No. And those rates are all still in the fives, I was just looking at those rates this morning,
Yeah.
quite a bit of difference there.
Yeah, when we saw the 30-year fix, we're like, okay, what did our rates do over on this side? But, and then just a little FYI, some things that are coming into works, actually starting this month with Fannie and Freddie Mac. So those are your conventional mortgages, 30-year, 15, 20-year fix. They are trying to ease some burden on first-time home buyers especially that only have 5, 10, 3% down. So normally when you're doing a conventional mortgage, your rate is based off your score. So 740 is the target, that gets you the best rate, and then it kind of, you have pricing adjustments the lower the score goes. Now they're coming out, like if you have a client that's gonna be 5% down and say they have a 680 score, that pricing adjustment's not gonna be so brutal for them, which is great. That helps a lot with the rate, that helps a lot with the payment, what they can qualify for. The catch to that is the clients that are putting 20% or more down that have better credit scores, well, their pricing's gonna get a little worse because there's the give and take in that world. They're also going to start increasing the interest rate if a client's debt ratio is over 40%. You all have no way to know this, but what we have to do as loan officers when we're pre-approving somebody, if their debt ratio is 39.5%, you know, we've got to make sure we're looking to make sure that if that insurance premium ends up being a little higher than what we're anticipating, what's that going to do to their interest rate? So just a little FYI, again, on the importance of working with an educated, knowledgeable loan officer, because these changes, I mean, it's going to be us getting out and being like, okay, there's an adjustment for this, and this. And then also, that doesn't apply in portfolio. So, you know, the score and you know, debt ratio, we don't deem the rate for that. So, but just kind of keep that in mind, you know, when you have a client that's like, yeah, I got pre-approved, but I mean, I'm maxed at this. Well, that needs to kind of trigger you to maybe reach out to that loan officer and say, so, what's their rate? Because they're saying their debt ratio is maxed out, you know, and making sure that they're aware that they priced it that way. Because if they didn't, the underwriter is going to catch it, and then the debt ratio is going to be too high, and then you're not going to have a loan that can close. So it's just really important, you know, to make sure that you work with a loan officer that knows their stuff like that.
Underwriting is done in-house, right?
Yes. Yeah,
It's a big game changer.
it is.
Yes.
Instead of sending it to like another state.
We take
Right.
our 2 Lexington underwriters out on a quarterly basis and buy them margaritas.
There you go.
We take good care of them.
We do. Exactly.
So,
Any other questions? These are all the great questions.
I have one that's lingering, I think I might know, but I just want to clarify, the lock-in period for a rate, for your portfolio loans, let's say goes past 30, 45 days, is that an issue, or?
Standard locks are 45 days, and then we offer a free 3-day extension. Sometimes just that 3 days can be the game changer. But standard locks are 45 days, and then there are extension fees that can be applied to keep that rate if they choose to do so.
Yeah, we were in that situation and Rebecca was amazing. She helped so much, oh my goodness.
I just got a contract yesterday for April 3rd, and it was just because the sellers needed more time, but I knew rates might be moving, so we locked that doctor in yesterday, and they did move today. But we might use that free 3-day extension if the sellers are hard and fast on April 3rd. So, I mean, there's some days that, sometimes that those things make a difference.
So in our case, she was so thoughtful. You know, there was the charges if your rates are expired and the seller didn't want me to pay. She didn't wanted my buyer to have that charges, and she knew the rate will be almost same, so she let that expire and she got it back again. She was so thoughtful and so smart. You know, otherwise she would have said, you know, just pay, and then, you know, we would have done something, you know, but she was.
And that is something with their portfolio rates, they don't move as much as Fannie Freddie rates do, because we control that. So if we have a client whose rate's gonna expire and the rate hasn't changed on their portfolio program, we just let it expire and just relock it, because it's the same thing. But you can't do that on a Fannie Freddie loan, so there is an extension fee, so that's another really cool thing, so thank you for bringing that up. That's
She's
another,
very, very thoughtful, so
thank you.
take all your business to her then.
Yeah.
And relax.
Yeah, she's definitely the brains. She sent me a text yesterday, lock anybody in that might be on the fence, so it definitely comes down.
Another good thing is they make a great team, so anytime she's out of town, she'll let you know and Don will be there to help. So that's so great.
Because
you
she's
know.
super nervous when Dawn's out and having fun.
Yeah.
I don't know
Yeah.
why.
I'm
But-
like losing
It's
a
good.
family member's not in town, like, oh my gosh.
Yes, like, I promise it's good.
He finally went on his first vacation after 5 years, so
Yay!
maybe now.
I knew you looked more relaxed. Good for you.
Yeah.
So, well, thank you guys for having us.
Thank you so much.
Yeah, we're gonna leave this extra, the goodies here for anybody that's joining us virtually.
Thank you, guys. Enjoy
Thank you.